Next, we will start Ind AS 34 interim financial reporting ka revision. So, what does interim financial reporting mean? First of all, what is an interim period? Interim period means any period lesser than 12 months. Any period lesser than 12 months, we call it as interim period. That could be 2 months, 6 months, 3 months, 8 months, whatever. If any period is less than full year, that is 12 months, we call it as interim period. And for that interim period, if you are preparing any financial statement, we call it as interim financial statements. So interim financial statement simply means a financial statement which you are preparing it for less than 12 months. Okay. But usually as per SEBI requirements, listing arrangements, you have to give quarterly wise data. That's the reason that saying is popular. We prepare financial statements on a quarterly basis. But in reality, you can prepare financial statements for any period lesser than 12 months and everything is called as interim financial statements only. And if you're preparing interim financial statements, how to prepare, this particular standard gives us the guidance. Okay. And what Ind AS 34 says is, whenever you're preparing Ind AS interim financial statements, you can prepare it like complete set of financial statement. Now, when you prepare annual financial statements, you'll get full data. No, the way that we call it as complete set of financial statement. Annual financial statements are complete set of financial statements. Every data will be included there. In the same fashion, you can prepare interim financial statement also. The way you're preparing annual financial statements, in the same form, you can prepare interim financial statements also. That is one choice. Or you can prepare condensed set of financial statements. Either a complete set of financial statements or a condensed set of financial statements. Condensed means little lesser. Not like annual financial statements, but little lesser. Okay, that we call it as condensed set of financial statements. Condensed set of financial statements will consist of condensed balance sheet, condensed P&L, condensed cash flow statement, condensed statement of changes in equity, condensed notes to accounts, all this. Okay, so little lesser version of the annual financial statement, we call it as condensed. Okay, Saru? Yes, sir. Sir, how do we prepare this for interim financial statement, sir? Sir, if you're preparing interim financial statements or if you're giving complete set of financial statements as interim financial statements, because there is a choice. Interim financial statement also you can prepare like complete set of financial statement. So if you have taken that choice, then you have to prepare that complete set of financial statement as per Ind AS 1. Ind AS 1 gives a guidance as to how to prepare a complete set of financial statement. You have to apply that guidance. So same way you have to prepare interim financial statement also. Except the period will be lesser, that's all. In Ind AS 1, which talks about 12 months ka financial statement. Now you will prepare only maybe 3 or 4 or whatever months ka financial statement, but using the same guidelines as given in Ind AS 1. That you will apply only when if you're preparing complete set of financial statement. However, if you're preparing condensed set of financial statement, what the Ind AS 34 says is the heading, the subtotals. The heading and the subtotal should be as per the latest annual financial statements. The heading, the main heading, equity and liabilities, equity, other equity, we like that we give the heading, no? The heading and the subtotals should be exactly as per the latest annual financial statements. However, additional line item like financial asset is one of the header. Under financial assets, you will show various financial assets, no? Like cash or debtors, etc., etc. That is your additional line item. So additional line item, if the company feels it is necessary, then they can add it or they can show it, or they can write financial assets and prepare on the balance sheet like that. Okay. So additional line item is company ka choice. If company feels if we don't show additional line item, then interim financial statements will become misleading. The user will not be able to understand it. Then they can include it. So basically, to show additional line item or not, it becomes the company ka choice. That's where the judgment of the company comes into picture and they can take a call. But the main heading and the subtotal should match. The interim financial statement ka and annual financial statement ka heading and subtotal should compulsorily match. Additional line item, company has a choice. That is one. And BEPS and DEPS also should be reported. Okay. Certain extra things also you should give in the disclosure, like if you have done any impairment in the interim financial statements, if you have written down inventory net realizable value, if there is any litigation settlement, etc., etc., you also need to disclose that. It may not be that important for examination. Okay, this could be one setup. Here only hardly 2 or 3 types of questions usually comes from this particular topic. One thing is the period. What data to give for interim financial statements? So let's take a small example. Let's say interim current year is 1st April 2019 to 31st March 2020. That is the whole year. Interim financial statement means we are not concerned with whole year ka data, we are concerned with lesser data, right? Usually companies present interim financial statements on a quarterly basis because of SEBI ka requirement. That's the reason. Let's say we are preparing interim financial statements for July to September wala quarter. July, August, September. That is your second quarter. Not April, May, June, July, August, September. Second quarter, we want to prepare interim financial statements. Interim financial statements will consist of balance sheet, P&L, cash flow statement, SOC. So what in all period ka balance sheet, P&L, SOC and all we need to give is the question now. Okay. So first, if you want to prepare balance sheet, so your quarter 2 is ending on which date? September 2019. That is 30th September 2019 in this particular example sake. Yeah, it could be anything. In like this, they will give you some data in the question and ask you to prepare for what period you will have to prepare balance sheet, P&L and all. They will ask. There's only the answer. There's only question. There's only answer. Okay. Okay. That's all you need to write over here. So if your interim period is ending on 30th September 2019, one balance sheet on 30th September you need to give. So interim period ka ending date ka balance sheet you need to give. That is one. Okay. And second, not only this, you also need to give. This is interim financial statement. No, has the year already ended? No. So previous year ka annual financial statements. When did you prepare previous year ka? This is second quarter. Okay. I mean, this year is not ended. This year is ending on 31st March 2020. We have not gone to that stage. So which year is already ended? 31st March 2019 has already ended. So along with interim date ka financial statement, you also need to give previous year ka balance sheet. Previous year is not previous quarter ka. Okay. Previous year ka balance sheet you need to call out. That means balance sheet you would have prepared on 31st March 2019. That data has to be given. Okay. Just again for comparison purpose. Fair enough, people. One is the balance sheet on the end of the interim period, which is 30th September, and previous year ka balance sheet you need to give. This is a balance sheet ka interim financial statement ka requirement. Next is P&L. P&L is simple. What is the P&L is prepared for a period, right? Balance sheet is a statement that is prepared on a particular date. P&L is for the whole year that you give, right? So here you're preparing P&L from July to September, right? So you need to prepare P&L for July 2019 to September 2019. That is the current year ka 3 months period you need to give. Okay. All right. That is it. And same period ka last year data you need to give. This is 2019, no? So same period ka last year data, which will come July 2018 to September 2019. So this is the last year. That is one. Current period ka, current 3 months ka P&L you prepare, and you need to prepare and disclose. And last year ka same period ka data you need to call. That is one. Okay. This is period ka data. Not only this, you also need to prepare YTD wala data. YTD means year to date. So here the period is July to September, but is the current year beginning from July or from April? So the current year is beginning from April and the interim period is ending on 30th September. So from year to date means from the beginning of the year till the end of the interim period. So from 1st April to 30th September 2019. From 1st April 2019 to 30th September 2019. That is your year to date wala data, which is 6 months ka data you need to call out in this example. Okay. Same YTD data of last year also you need to give. So April 2018 to September 2018 wala data. Okay. So P&L you have to prepare it for the period also, for year to date also. And period ka data you have to give it for last year also. YTD data also you need to give it for last year also. That's the thing. That's about P&L ka. Cash flow statement and SOC is similar. You don't give period ka data, you only give YTD data. Year to date data for cash flow and statement of changes in equity. So year is beginning on 1st April and ending on 30th September. So from April 2019 to September 2019 wala data you will give. And same YTD data of last year also you will need to give. So YTD data of current year and last year, both you need to give it for both cash flow statement as well as statement of changes in equity. That's all. Okay. This is one kind of a problem. Another kind of question they ask is about the recognition. Sometimes they will give you one expense and they will say, we are in first quarter now. Company wants to defer first quarter ka expense to second quarter because the sales in the second quarter is more. So is deferment allowed? So they'll talk about deferment of expense, deferment of income, etc., etc. Okay, the simple thumb rule or the simple way to remember this is, sir, think that you are preparing annual financial statements. Think that you are preparing annual financial statements. In annual financial statements, can you defer the expenditure? One expenditure of 1 lakh has accrued. Okay, and you're preparing current year ka financial statements. Will you defer it to next year or will you book it in current year only? If it is accrued in the current year, you will book it in current year only, correct? Will you push it to next year? No. So if deferment can be made in annual financial statements, then deferment is allowed in interim financial statement also. If you cannot defer while preparing annual financial statements, then you cannot defer while preparing interim financial statement also. That's all is the rule of this particular thing. That's all you remember. They will give you data. I'll take you through one question, how they give you this. Okay, that's all. Okay. If deferment is allowed in annual financial statements, deferment is allowed in interim financial statement also. If deferment is not allowed in annual financial statements, in interim financial statement also, deferment is not allowed. That is one. Okay, I'll take you through one question. Hang on. One more is, first I'll finish off one more small concept, then we'll take up some questions only. So another thing is something called tax expense. Sir, in your financial statements, may you show tax expense, no? So in interim financial statement, may also you need to show tax expense. But here it is not based on the normal. Here you have to book the tax expense based on WATR. That's what we used to call in our class, right? WATR. WATR means weighted average annual tax rate. So you will book the tax expense based on weighted average annual tax rate. So how do you get this WATR, sir? Yeah, we're not getting water only now. Everybody is facing water shortage. Yeah. All right. So how do you get this water is expected tax expense in the current year divided by expected accounting income in the current year into 100. I'll take you through 1 or 2 questions. This is popular in examination, this particular adjustment. Okay. And in interim period, can you reverse impairment loss? No. Impairment loss on goodwill can never be reversed, both in annual financial statements as well as in interim financial statement. Okay. So let's run through a few questions to understand whatever we have learned a little better. ABC Limited presents interim financial report quarterly. Okay, on 1st April 20x1, ABC has a carry forward loss of 600 lakhs. Okay, for income tax purpose, on which DTA is not being created. ABC earns 900 lakh in each quarter for the year quarter ended 30th June, September, December, and March. Okay, every quarter they're expecting to earn 900 lakh rupees. Okay, 900 every quarter, so 4 quarters, so total will be 3,600. But will you pay tax on 3,600? No, there is a carry forward loss also. No, you will set it off and then you will pay. Tax rate they've said is 40%. You need to calculate how much is the tax expense for each quarter. So tax expense we know has to be booked on weighted average annual tax rate. Water. First, what do we need for that? Expected accounting income in the current year. First, let's find out how much is the expected accounting income in the current year. How much income you are expected to earn as per accounts in the current year. 900 is the income you are expecting every quarter. No, 900 lakhs. There are 4 quarters. So 900 into 4 is how much? 3,600. That is the income. Accounting income, expected accounting income in the current year. Then we need one more data, which is expected tax expense in the current year. Expected tax expense in the current year. Will you pay tax on the entire 3,600? No, since there is a carried forward loss. First adjust that. So 3,600 is the income minus there is a carry forward loss of 600. So the taxable profit only will be 3,000. And what is the tax rate? 40%. So 3,000 into 40% is how much? 1,200 you're getting. That is the expected tax expense in the current year. All right. So how do you get water is expected tax expense in the current year divided by expected accounting income for the current year into 100. So basically 1,200 divided by 3,600 down to 100, which is 33%. So every year, how much ever is your income, on that you will apply 33% and book the tax expense. Every year, how much expense are you income you are planning to you're expecting to earn? 900 lakhs. So 900 lakhs into 33.33% if you do, you're going to get 300. So every quarter you will book a tax expense of 300 lakhs. So tax is not straightforward, man. Tax here, as per Ind AS 34, tax you have to book on weighted average annual tax rate. So tax every year, every quarter is 300 lakhs. That is one point of question. Okay, maybe I'll take you through another same question first. Company expects to earn 15,000 pre-tax profit each quarter. All right. So 4 quarters are there. So expected income is 60,000. Okay, first. So maybe we'll write up that. Expected accounting income is how much? 15,000 into 4, which is 60,000. And corporate tax slab of 20% on the first 20,000 of annual earnings and 40% on additional earnings. So here income is charged on a slab basis. So the company is on a flat rate, no sir. Let's not question the question. Okay. So here they're saying it is taxable on a slab basis, means we will calculate on a slab basis. So income is 60,000. On entire income of 60,000, we have one rate. No, we have slab basis. On the first 20,000, you'll have to pay tax of 20%. So 20,000 into 20% is 4,000. We are expecting an income of 60. In that 60 on 20,000, you will pay 20% tax rate. The balance will be 60 minus 20, which is 40,000. On 40,000, you are expected to pay tax at the rate of 40%. So expected tax expense in the current year is 20,000. So how do you get water? Expected tax expense in the current year, which is 20,000, divided by expected accounting income for the current year, which is 60,000 into 100. So 20 divided by 60 is nothing but 1/3. So again, 33.33% is your weighted average annual tax rate. Based on this, you will book the tax expense every quarter. How much every quarter you are expected to earn? 15,000, 15,000, 15,000. So how much will the tax expense you will book? 15,000 multiplied by the water car rate, 33%. 15,000 into 33% if you calculate, that is 1/3. It will be tax expense will be 5,000 for every quarter. That's all. Okay, G. All right, G. There's one more like this. Let's do off this. Narayan Limited, a company, provides you the following information and asks you to calculate tax expense for each quarter, assuming there is no difference between estimated taxable income and accounting income. Estimates the same. Expected gross annual income is this annual income 33 lakh, inclusive of estimated capital gains of 8 lakh. So capital gain is taxed at a different rate. Normal business income is at a different rate. So whenever they give you capital gain via income over here, first exclude that. Only consider your business income. So total is 33 lakh. In that 8 lakh is capital gain wala income. So excluding capital gain, how much is your accounting income? 25 lakh, because it's a whole year ka data that they've given. So expected accounting income for the whole year is 25 lakhs. That was one. So next we need to find out expected tax expense for the current year. How is it taxed? What are they saying? What is the tax rate is 40% on capital gain. Tax rate is 12%. It seems okay. On other income, meaning business income, on first 5 lakh you have to pay tax at the rate of 30%, and on balance you need to pay 40%. Okay. So income up to 5 lakh 30%. Beyond that 40%. Income expected is 25 lakh. In this 25 lakh, on first 5 lakh you have to pay 30%. 5 lakh into 30% is 1.5 lakh. So in 25 lakh, first 5 lakh will be at 30%. Balance will be 25 minus 5 lakh, which is 20 lakh. On that you have to pay tax at the rate of 40%. So this will be 8 lakh. So the total expected tax expense for the current year is 9.5 lakh, excluding capital gain. Okay. So find out, you got both the data now. Find out weighted average annual tax rate, which will be expected tax expense in the current year divided by expected accounting income for the whole year. So 9.5 lakh divided by 25 lakh into 100, which you got as 38%. Okay. Now based on this, let's go on booking for each quarter tax expense. What is the income for the first quarter they gave? 7 lakh. Okay. Have they told this includes capital gain? No. Capital gain is included in third quarter. So when we get to that, we will see. First quarter is only business income. How much is that? 7 lakh. 7 lakh is the income. What is the weighted average annual tax rate? 38%. So multiply and book the tax expense for that quarter. Second quarter, their income is 8 lakh. 8 lakh into 38% water rate, and you will get 3 lakh 4,000 as the tax expense. Now in the third year, total quarter ka income, Q3 ka total income is 12 lakh. In that 8 lakh is through capital gains, and through business income it is 4 lakh. Okay, so you need to calculate separately. On business income, you'll apply weighted average annual tax rate. On capital gain, you'll apply capital gain ka tax rate. So on this 4 lakh, you'll multiply weighted average annual tax rate of 38%. So 4 lakh into 38% is this much. On your capital gain income of 8 lakh, you have to apply capital gain tax of 12%. So 8 lakh into 12%, that will give you the tax expense for that quarter. Okay. So total put together gives you third quarter ka total tax expense to be 2,48,000. So split it accordingly, apply the respective tax rate and get it. The last quarter they said only 6 lakh. Now no data about capital gain. That means entire thing is business income. So 6 lakh multiplied by weighted average annual tax rate of 38% you calculate, and you'll get the tax expense. So this is your total tax expense for all the quarters put together. Okay, G. All right. The next one is, I talked about deferment of expense. No, that one. Now check this. A Limited manufactures automobile parts. ABC has a net profit of 20 lakh. So correct for the third quarter. For the third quarter, as per the company, for the third quarter, the profit is 20 lakh. Now they would have done some extra harkates or extra fittings. We'll see what those. Following adjustments were made while computing the net profit. They calculated 20 lakh by keeping these things in mind. Bad debts of 1 lakh incurred during the quarter. So bad debts is relating to this quarter only. Okay. 50% of the bad debts have been deferred to next quarter. That means bad debts of 1 lakh incurred during the quarter. So total bad debts is 1 lakh. That means how much you should book it as, how much you should book it in P&L? 1 lakh. But what did the company do? 50% they booked it in current quarter. Another 50% they are pushing it to next quarter. Now you think, if you're preparing annual financial statements and if you have suffered a bad debts of 1 lakh, will you push it or account it in that year itself? You'll account it in that year itself. So is deferment of bad debts allowed while preparing annual financial statements? No. That means, do you think deferment will be allowed in interim financial statements? Not acceptable. But the company has deferred? Yes. That means how much bad debts they have not booked? 50%. Can we ignore this? No, we have to book it now. So when you book a bad debts, what will happen to your profit? It will reduce. They booked only 50%. They have not booked another 50%. So 1 lakh into 50% will give you 50,000. That's something which they have not booked. Reduce it now. Due to bad debts, profit will reduce. Hence, I have reduced 50. Like this, you need to do some plus minus adjustment here. That's all. Okay. Additional depreciation of 4.5 lakh was result due to change in the method of depreciation. Change in the method of depreciation is an accounting estimate change. So whenever you get an excess depreciation, you have to account it that way only, and they have accounted. So what they have done is correct. Nothing fancy over here. Exceptional loss of 28,000 incurred during third quarter. So you have suffered a loss. Exceptional, extraordinary, whatever. You have suffered a loss. If you have suffered a loss means you have to account it the moment you suffered a loss, you have to book it in that year or that quarter only. But what has the company done? 50% of exceptional loss they have deferred to next quarter. Is that acceptable? No. But have they done it? Yes. So 28,000 into 50% you calculate. That will be 14,000. They have not booked, but we need to book now. So when you book a loss, profit will reduce. So minus 14,000 you need to do. Okay. Now 5 lakh of expenditure on account of administrative expenses pertains to third quarter. So this we are in third quarter only, and this 5 lakh expenditure belongs to third quarter only. So should you book it? Yes. Because it is relating to that quarter means you should book it in that quarter only. But it is deferred. Company has deferred it. What argument they are putting? They are arguing that fourth quarter ka will have more sales. The company is arguing that the fourth quarter will achieve more sales, so I will book more expense. Is that acceptable? This is not based on your sales and all. It's based on accrual concept. If the expense is accrued for a particular date, you have to account it in that year only. So company does it relate to this quarter? Yes. Has it accrued? Yes. But has the company accounted? No. They want to defer it. So is that acceptable? Not acceptable. So what do you have to do? There's an expense. When you book you have to book this expense. So due to this, P&L will reduce. So reduce 5 lakh rupees. Finally, you will get how much? You have to do all this adjustment and get the revised profit, which is 14,36,000. That's all as a treatment in this. 1 or 2 lines we need to write about deferment. You need to call out that I've given you in your regular notes, regular class there that you can go through. Then do this plus minus and get the revised profit. These are those kinds of questions. Hanji. Okay. One more thing is this. This is a little different. Okay, fixed production overheads for the current financial year is 10,000. It's for the whole year. Normal expected production is, they're saying is 2,000. I'll give you only the relevant data. They've given full story. So normal capacity is 2,000 metric tons. So actual capacity is only 9,900. You have a capacity to produce 2,000 metrics of some product, but in the current year you only produce 1,900. We have already learned this in our CA intermediate AS2 as well as Ind AS2 also. Fixed overhead should be absorbed based on normal capacity or actual capacity, whichever is higher. I've given you the logic and all that. Calculator example I took, yes. Okay, now I'll not go into that. So fixed overhead should be absorbed based on normal capacity or actual capacity, whichever is higher. Your normal capacity is 2,000, actual capacity is 2,900. The higher amount is 2,000. So you'll absorb based on this. How much is the total fixed overheads? 10,000. So 10,000 has to be absorbed by 2,000 units. So each unit will absorb how much? 10,000 divided by 2,000, which is 5 per unit. Okay, sir. Okay, I've given this data for annual financial statements for you only for reference, how it looks in annual financial statement. So 1 unit of inventory will absorb a fixed overhead cost of 5 rupees. How much of units of production or how many units have you produced in the current year? 1,900. On 1 unit, you will allocate fixed production overhead cost of 5 rupees. On 1,900, how much? 1,900 into 5 will be 9,500. But how much fixed overhead cost did you actually incur in the current year? Actual fixed overhead cost is 10,000. But how much got absorbed in inventory? Only 9,500. Yes, that means another 500 will be transferred to P&L account. This is what you used to do in your CA inter and normal Ind AS2 wala questions. Okay, but they're not asking. This is the annual related data. They're not asking annual related data. They're asking you how the same will be absorbed in interim financial reporting. That's all you need to do over here. Okay, same thing. How we will absorb over 4 quarters, not annually. Each quarter, how we will absorb fixed overhead cost. Okay, how you have to do this over here is check. First, absorption matrix is still the same. To find out the total fixed overhead cost, which is 10,000, that will be absorbed by the total normal capacity or actual capacity, whichever is higher, which we have already got it. Fixed overhead cost per unit is how much? 5. That will be the same. Okay. What you have to do is first quarter, how many units of production? Now, basically 10,000 is the total fixed overhead cost. We have 4 quarters. So every fixed overhead cost per quarter will be how much? Annually fixed overhead cost is 10,000. For quarterly fixed overhead cost will be 2,500. Correct? Now we have to see is entire 2,500 getting absorbed in inventory or some portion will go off to P&L. We checked it at annual level. Now we have to check it on a quarterly level. So every quarter ka fixed overhead cost is 2,500 now. 10,000 divided by 4. This 2,500, will it be transferred to P&L or will it get absorbed in inventory is what we are trying to test. Okay. First quarter, how much did you produce? 400 units. How much each unit will absorb fixed overhead cost? 5. On each unit, 5 you will absorb. So 400 into 5 is how much? 2,000. Okay, 2,000 will be absorbed by inventory. But how much is the fixed overhead cost for the quarter? For quarter 1, it is 2,500. So 2,500 was a cost for the quarter. but only 2000 got absorbed. I mean, how much will be transferred of P&L to P&L? 500 rupees will be transferred off to P&L in the first quarter, like that. Okay. Now, same thing you have to do it for second quarter. But when you come to second quarter, you have to do this on a consolidated basis, not just quarter 2 data alone. You have to consider quarter 1 and quarter 2 because it's absorption. No? So total has to be absorbed. So from quarter 1 to quarter 2, both you need to compare. Like here. Now we are in quarter 1 to quarter, you have come to quarter 2. No? So totally for both the quarters put together, how many units have you produced? 400 in Q1, 600 in Q2. So total is what? 1000 rupees. Okay. 1000 units you have produced till quarter number 2. And each unit will absorb how much? 5. So 1000 into 5 into how much, sir? Totally, how much can you absorb? 5000 rupees. 5000 can be totally absorbed in inventory. Yes, sir. Okay. So now we are not doing just quarter 2 data alone. We are doing it on a consolidated basis. So Q1 and Q2. What is fixed overhead cost per quarter? 2500. How many quarters we are considering for this data? We are doing consolidated data. So 2 quarters we need to consider. For both the quarters put together, what is the fixed overhead cost? 2500 actually. 10,000 was for the annual. Okay, for each quarter, how much? 2500. We are talking about two quarters over here. For one quarter, if it is 2500, for 2 quarters, it will be 5000. So our actual fixed overhead cost is 5000. How much got absorbed? 5000. That means, is there loss? No. 5000 is the cost. Entire 5000 got absorbed. But in the previously, you already booked the loss. Correct? No. Previously, you transferred some loss to SPL. Now, is there any loss in Q2? No. That means what you have to do? Reverse. Whatever loss you booked in the previously in SPL, that we need to reverse. Like this, you need to compare it on quarter comparison. You have to do. Okay. So if there is any loss in the previous quarter and if it got absorbed in the next quarter, whatever loss you booked in the previously, you need to reverse it. Again, the simple funda here is you need to work with not just quarterly data. You have to work with year to date wala data. Both. If you are in Q2, you need to consider Q1 ka data as well as Q2 ka data. Q1, Q2 put together, totally you produce 1000 units, and for each unit it will absorb 5 rupees. So 1000 into 5 will be 5000. That much got absorbed, that much fixed overhead got absorbed in inventory. And what is the fixed overhead cost for fixed production overhead cost for both the quarters put together? For one quarter 2500, for 2 quarters it will be 5000. 5000 is a cost, 5000 got absorbed. That means there is no loss. But previously you already booked the loss. So whatever you booked, you need to reverse that way. Now work with the same data for Q3. Now we have come to Q3. So what you have to consider? Q1, Q2, Q3. From the beginning you need to work. So adding all this, how much you're going to get? 1500. Yes. So 1500 units you have absorbed. And each unit of inventory will absorb how much of fixed overhead cost? 5 rupees. So 1500 into 5 is how much? 7500. That much will got absorbed into inventory. Okay. Now how much is the fixed overhead cost for 3 quarters put together? For 1 quarter it is 2500. For 3 quarters it will be 7500. Actual fixed overhead cost is 7500. How much got absorbed? 7500. So is there any loss to be transferred to SPL? No. Is there any reversal? No, reversal will be already made. Whatever loss was there in Q1, we have already reversed. Okay. No further reversal is remaining. So in the third quarter, there is no loss also. There is no reversal of loss also. Now the last quarter, fourth quarter. Fourth quarter, now you have to work with how much units have you actually produced for all the 4 quarters put together. For all the 4 quarters put together, it is 1900. And 1 unit will absorb how much? 5 rupees. So 1900 into 5 is how much? 9500. So 9500 units got absorbed, or 9500 of fixed overhead cost got absorbed into inventory, goods produced. Okay, not necessarily inventory, but into the goods produced. Okay. What was the fixed overhead cost for all the quarters put together? 2500 for 1 quarter. We are in the 4th quarter now. So that means the total fixed overhead cost was 10,000. 10,000 was the total fixed overhead cost, but you in unit produce may only 9500 got captured. That means balance 500 rupees is a loss which will be transferred to PL like that. Okay. So this is this particular problem. So this is another little different problem. So this also I think has been asked once or has a potential to come as well. So watch out for it. So with this, Ind AS 34 also damn damar.